Peter, Happy New Year to you. I'm just going to make you a panelist, and then I will show my screen so we could show your website. Happy New Year, Peter. Let's see if your mic.
I just unmuted.
Can you hear me?
I can hear you now, Peter. Happy New Year, buddy.
Okay. Yeah, you too. Thanks for having me again.
All right, it's great to have you, Peter. Excellent time to talk to you. Finally, what you had been talking about for a year, even though the market went nowhere, the market did not recognize the shape of what could happen while the Fed was trimming its balance sheet, which is something you've been warning investors about for quite some time, and better early than late, don't you think?
Yeah, I think people forgot the giddiness and enthusiasm that QE created, and there was this market nonchalance that QT would not be that big of a deal. I mean, for a while it was not to markets because the Bank of Japan and the ECB were going full throttle. But as that began to recede, it all of a sudden began to matter. So in the fourth quarter of 2018, the net liquidity changes on the balance sheets of the Fed, ECB, and the BOJ went to a zero as of October 1st, and the market topped out 2 days later. And then in Q1 of this year, we have now a liquidity draw. If you add up the central bank balance sheets of the three, since the ECB is now no longer expanding the size of its balance sheet. So I still think that'll be a factor, major headwind for markets this year. Obviously, now there's a question of how much more the Fed's going to let the balance sheet decline. But as long as on a monthly basis they are letting it shrink, I think that will continue to be a headwind for flows here.
Okay, so last time you were on, Peter, you said you liked emerging market debt, and I really don't follow any of those instruments, but I'm assuming it did okay because even U.S. Treasuries put on quite a rally during risk off. How did emerging market debt do with the sideways dollar?
So it actually hung in. It was EMLC, Eddie, Mary, Larry, Charlie, which is the local currency EM ETF that I like, was actually unchanged in December. So considering the carnage in many other areas of the market, that certainly is a victory. And then in the first couple weeks of 2019, it's had a nice bounce, coinciding with the dollar weakness because of the Fed being more dovish and likely backing off more rate hikes. So I still expect continued pretty good performance in that space and with a pretty good dividend yield.
Okay, so why don't we talk about the Fed now, Peter? Because it seemed like they had they got religion at 2,300 or so in the S&P, and they started talking about, all the dot plots came back to maybe one hike, maybe even an ease. Do you think that it really depends on where the market is to what the Fed is going to do? Say, for example, we're rallying into March. Do you think they go ahead and tighten? Whereas if the stock indices are falling into March, they stay pat. Are they that market sensitive about what ongoing policy is going to be like? No
question. So now we've defined the strike price of the Fed out of the money put. At being 20%, and that out of the money all of a sudden became in the money at down 20%. So they definitely focus on it big time, because that's what one of their goals was to juice asset prices through all those experiments of QE. Exactly. So this certainly goes back to Greenspan and the asset price dependent economy that he created. And all anyone has to do is just look at a chart of net worth relative to disposable income, sort of a metric of asset prices relative to the underlying economy, and you can see that ratio is at about 700%, well above where it was in 2000, well above where it was in 2007. So we are hugely dependent on asset prices. I think the Fed understands it, but certainly not to nearly the same extent as they should, because they keep talking about financial conditions, whether they're easing or they're tightening, but they don't seem to understand that their actions on rates in the balance sheet is the reason why they tighten and they ease. So when they raise interest rates, when they shrink their balance sheet, financial conditions tighten, and then that causes worries about growth. And then the Fed says, well, financial conditions are tightening, let me back off. And then they start to ease again. And I don't think they realize that it's a cat chasing its own tail. They still think it's somebody else's tail.
Okay, so that's confusing. So they're confused. And what do you think their course of actions could be? You know, people think the Fed's infallible, but how many times have they overshot on both sides? Quite a few times, even with a 100-year track record. So are you betting that they overshoot by staying tight too long? And what would okay, go ahead, Peter.
No, I wouldn't be surprised if they were no longer going to be raising rates this year. But to your point earlier, if we do keep on rallying and the economy actually does stabilize, well, then they will raise. So there's this pick your poison thing. They're done now because the growth is going to slow, or they keep on raising because growth gets better, but at some point growth will eventually slow. Because we have to remember, the economy and markets ebb and flow now with monetary policy. We are tied together. We cannot separate it.
Twins, right? There was no handoff. There was no handoff that we thought we were going to get, right?
When you are in a credit addicted, credit dependent economic cycle, it is intertwined. Whereas historically, before the 2000 and 2008 recessions, it was more recessions were caused by more of inventory changes and changing some savings rate. We've never been this addicted to the cost of capital and liquidity. So it is intertwined. So the Fed is in a no-win situation no matter what they do. Now, that said, I do think they're probably done raising rates because I do see the economy continuing to slow, both here and overseas. But the balance sheet's going to continue to shrink for a period of time until we get some more accidents.
Okay, so would an accident under this law of the S&P weekly chart that I'm showing right here, and say, you know, I know a lot of people are looking for, you know, maybe in this range down here, Peter, would that be enough to cause the Fed to panic and ease?
Well, the first thing they'll do is they'll say, okay, we're no longer going to shrink the balance sheet, and then they'll look around and see what's going on. But yeah, at some point, if it starts to filter into the data, because they keep talking about the data driving their behavior, well, yeah, they'll start to cut. But you know, the problem is that is the Fed just going to go back to the old playbook of, you know, cutting rates back to zero, and if that doesn't work, doing QE and thinking, you know, they're going to get some better results? I mean, at the end of the day, changing
what other
rates,
playbook do they have besides?
Well, they don't. But the question is, do they think that cutting rates is actually going to help when you have an issue of too much debt?
Yeah.
By lowering the cost of money, is that really going to matter and encourage people to take on more debt? I argue it's not going to be in the next downturn, and that will separate the next downturn from previous ones. Is the Fed won't have much ability to stimulate economic growth. The ECB will not, the BOJ will not. So any downturn we get is not going to see the typical V bottom that many are used to.
Okay, well, maybe it doesn't last 10 years and it has effect for 10 months. What do you think of that?
Well, we'll see, but I think the next economic downturn, the next sell-off in markets, could bounce along a bottom for a while, and instead of
like
a
an
V bottom, or a bathtub such.
All right, so I know you've been constructive metals, and you know we have a decent formation here, and even a lot of traders I know that were bearish and looking for one more washout are starting to change their tune. That now you should be buying breaks at 1270, 1250. Do you think the gold is smelling what you're talking about? Because this gold advance, Peter, happened without a weak dollar. I mean, the dollar's mainly been sideways. We finally got a little bit of a hit late last week, but euro's struggling. Maybe it could rally to 117. But gold did this on its own. What do you think is behind it? Smelling exactly what you're talking about? Safe haven buying?
We have seen dollar weakness against emerging markets. I mean, even the Chinese yuan last week got to a multi-month high, and even the euro. I mean, when you look at all the challenges that Europe faces, they still have trillions of dollars of negative interest rates. The ECB balance sheet relative to the size of the European economy is bigger than the U.S. We have growth that is going to maybe have a one handle on it this year. We have political issues, and the euro is still trading at 115. I actually think the euro trades remarkably well in the face of all those challenges compared to the dollar. So I'm actually impressed by the action in the euro. But importantly, real rates, which is what gold really should trade off, real rates are at the lowest level since the middle of September. So we had a 4-month low in real rates. That has been
zero. Is it around zero right now?
Gold. Well, if you go out 5 years, I like to look at the 5-year, and real rates are positive by about 85 basis points. But at the end of November, it was $1.15, 1.15% in real rates. So that fall has coincided with this decline. This increase in gold, but also being helped by the weakness in the dollar.
Okay. All right. So we're looking at gold. As you can see, when I put the two charts together, gold has way outperformed euro. Maybe what's been going on is gold has been rallying in other currency terms and finally is rallying in dollar terms because all these other currencies have been under pressure. If you own gold, you did okay. Now it's finally happening in dollar terms, or maybe across all fiat now, which would be a real bullish signal for gold if it's rallying against all fiat. So I'd like to go to an article that you wrote here, Peter, on your website and show people that they could subscribe to it. So this headline: shut down China, euro, OPE 70%.
Well, Europe, yeah.
Europe, okay, Europe 70%. What's the cliff notes on what you're trying to say here? You wrote this today.
Well, I think with respect to the shutdown, to me, there are a few guarantees in life: death, taxes, and if the government shuts down, it'll soon reopen. But this is lingering on longer than I think most people imagined, and I'm really not concerned about the shutdown. Yeah, I'm not really concerned about it because I know it's going to reopen at some point, and it will clip GDP estimates, but a lot of the lost pay will be returned. But there will be some business that's not going to be recaptured, and now that you have the shutdown affecting the TSA, I think that is going to be the impetus for a deal sooner rather than later. That now you're beginning to piss off the average person, and setting aside the pissed off people that actually work for the government that are not getting paychecks. But now once you start pissing off the general population who just wants to fly from point A to point B, then the politics get messy for both sides. Now, with respect to China, we had trade data that was weaker than expected, and certainly is a catalyst for the weakness we're seeing in markets everywhere. And we saw continued softness in European data, and it's just confirming that global growth is slowing. And we are on the cusp of earnings season in the U.S., where 40% of S&P revenue is sourced overseas. And while I'm sure that 70% of companies will beat earnings estimates, because that's always the case, I'm expecting a lot more revenue misses relative to expectations. And
the banks lead it off. The banks lead it off this week, right?
Well, yeah. So Citi reported today, and they beat EPS, but they missed revenue. And I think that may be a common theme throughout earnings, and that you're going to get a low level of companies that are actually beating revenue for the reasons I stated, whereas on the bottom line standpoint, you can easily beat revenues because you lower the bar, you buy back stock, you cut costs, you trim your tax rate, so on and so forth. But watch the revenues and certainly watch the guidance.
And the 70%, that means what?
The 70% is about 70% of companies historically beat earnings per share, but that's the bar. So if we see that again, that doesn't mean earnings were good. that just means that they were, normal. So anything below that would tell you that that would be disappointing, and vice versa.
Okay, I know that almost everything that you look at are, based upon fundamentals, and I'm curious as to what you think, if there is some type of market analog between presidential problems and potential impeachment, between the Nixon era, which I believe we entered a bear market for quite some time, and what's happening today. Do you see any parallels between that, and maybe can this even have heavier weight than Fed action?
I think at this point, with respect to the Trump administration and what markets want, they got what they wanted in the tax cut. They got what they wanted in terms of regulatory relief. And the next thing they want is resolution on this trade situation with China and getting rid of these tariffs, not just with China, but these steel and aluminum tariffs elsewhere. Anything else that happens with Trump, whether it's impeachment, whether it's Democrats just continuing to make his life miserable, I don't think the market cares. The market wants this trade situation resolved, and I think everything else pales in comparison at this point, again, because he got his big legislative initiative in place at the end of 2017 and being in the tax bill.
What about the fact that I think Fitch is talking about a downgrade of U.S. debt?
As long as we have a printing press, everyone will get repaid. It'll just be what's the fate of the dollar in that. So I see the downgrade being more of an impact on the U.S. dollar rather than anything else.
Okay, Peter, and do you believe the recent lows that we had after the worst December since the Great Depression are going to hold or be taken out by quite a bit in most of the major U.S. forces?
I think there's a greater than 50% chance that we're in a bear market. So if that's the case, after 10 years of an extraordinary run, extraordinary monetary policy, this bear market's not just going to end in 3 months.
Do you think miners will act more like gold or act more like stocks if we get a sell-off like that?
Well, it's a good question. I'm sure some days it'll act like stocks, but I'm hoping more days than not it acts like gold. Okay.
Have you noticed the gold-silver ratio has shifted over the last month or so?
Yeah,
peaked at a pretty
beginning to trade well. Yeah, and I think the whole space with now you're able to take the Fed, outside of the balance sheet shrinkage, at least on the rate side, you're basically taking them off the table. So, I don't believe that the Fed hiking is negative for gold, because again, you have to look at real rates, not nominal rates.
Right.
But there's plenty of people that do take that into account, and now that they're probably done raising rates, you can take that off the table. And so now I don't really know what the bear case is for gold anymore. If the Fed's done, the dollar's weakening, to me, this is just the beginning of what could be a really nice ride.
Any view on Brexit? No one knows what's going on there. You have a view?
No, you know what? My view is I'm actually pretty bullish on the British pound, because I think no matter what comes of this, I think whether it's a messy exit, a no-deal Brexit, or this or that, I think there'll be an adjustment, but life will go on in the UK. And I think that the level of the pound has priced in a lot of bad news. So when I go through in my head all the different scenarios, I see the pound actually having a nice rally regardless of how this takes place. So I don't know what the outcome is going to be in terms of the details, but I actually like the British pound here.
All right, and why don't we wrap it with the 10-year yield? We recently bottomed around 254 or so. Peter rallied to 275. I actually think we might make a move to 290 and then down again if we get risk off. You have a view on the 10-year?
Yeah, I still think yields are heading higher. What I find interesting is, in light of the global growth slowdown and the worst equity market we've seen in a while, the worst December since 1931, the 10-year yield is still up 30 basis points from where it was on December 31st, 2017.
So not much of a flight to quality.
Right, exactly, that people are used to. And to me, a big factor in the direction of the U.S. Treasury yield will be, where do European bond yields go when the ECB, and if the ECB tries to get out of negative interest rates.
Okay. And when will that become clear? And when does Draghi, if he's still in there, have to make a call on doing it? Do you know?
Well, they verbally said the latter part of the summer. So I think once you get to springtime, they'll hopefully start to give direction. Now they're screwed on this because negative interest rates has really damaged the profitability of the banking system. So they need to get rid of negative interest rates. But on the other hand, they risk blowing up the European bond market, which banks own a lot of European bonds.
Yeah, a lot of potential black swans there, aren't there?
Yes.
If they move that way. Peter, you know, you are a voice of reason in a world of market noise.
Thanks, Dale.
And I really appreciate our conversations, and you know, I walk away with clarity. Keep doing a great job on CNBC. I turn the volume up when you're on.
Thank you.
And you have a great 2019, Peter. Let's get back together in the spring and see what's going on then.
That would be great. Take care.
All right, everyone. Peter Boockvar. We'll see you tomorrow for Turnaround Tuesday. You could follow Peter at Boockvar, and you could go. He'll have a link on Twitter to go to www.bookreport.com, BOOCK report.com, and keep in touch with one of the better economists that I've seen on the air. He's a go-to guy for me. So enjoy the rest of your day. Don't just count your pips, count your blessings. See everyone for Turnaround Tuesday. Adios.